Hello and welcome to Analyzing Finance with Nick. In today's video, I'm going to talk about demand destruction and what it means for the broader economy. Before we get to demand destruction, I got to explain just how a typical demand curve works for a given product or service. And I'm going to use the example here of tennis balls. And I picked tennis balls particularly because they are something that is not a necessity. You can live without playing tennis. I mean, I play multiple times a week, but if so somehow the price of a tennis ball was $1,000 a can, I probably had to find something else to do with my time. And they are relatively disposable and limited use. For those of you who do play tennis, you can't keep using the same tennis balls indefinitely because once they're open from their pressurized cans after about 6 weeks of playing at the most, it loses its bounce and you have to replace them. So there's a stable need to replace the tennis balls. And if the price of tennis balls goes up, for the marginal tennis player, they're going to play less tennis. So say right now they're about $3 a can. If tennis balls went up to say $5 a can, I'll probably buy them slightly less frequency. Say tennis balls go down to say $1 a can, I'll probably buy a bunch of them, or since they're super cheap, I'll replace them quickly. Like instead of maybe replacing them every 4 to 6 weeks, I replace them every 1 to 2 weeks because it's a lot cheaper and vice versa. And so that's why you have this normal sloped demand curve where the price is where the supply level intersects the demand curve, and also that as the price goes down, the demand will go up in a pretty stable fashion. However, not everything is like tennis balls. In fact, really, demand destruction is not really hit for something like this. It's more for a necessity product. And the necessity product I'm going to use for an example is gasoline. Whether oil is at $40 a barrel or $140 a barrel, for most circumstances, when gas is, say, between $0 to $5 a gallon, the amount of driving that people do does not change that much. They'll still drive in their commutes. They'll still do their road trips to visit their family. Maybe some lower income individuals will batch their trips or not drive as much to save money or not travel really. But the degree of the change in quantity demanded by price is not nearly as consistent or as flowing as, say, tennis balls. Really, what happens is that people will keep buying the same amount of gasoline even as the price goes up because they need to get around, either to go to work or to go to the grocery store or to do whatever they need to do. However, there's a certain point where I call the break price. I'm not really sure that's what economists call it, but there's that basically demand drops from the fairly stable level to nothing overnight. Like above a certain price, it's just not worth driving at all. And so that's when you start to see people materially change their driving habits. It might not be complete zero, but it's a drastic shift in the curve that is not is not super gradual like a normal curve, but instead is sudden. And this is why oil prices tend to be so sensitive and move so volatilely. The most notable example is what really happened a few months ago when oil spiked to $130 a barrel, which was about $7 a gallon of gas in California and well above $5 in other parts of the United States. And it got to the point where people decided that they're no longer going to drive. I did a survey recently for my viewers to kind of show the impact of this. Like, what price would it break? And 40% of you almost said that current gas prices are enough for you to change your driving habits in a material way. And the vast majority of my audience would materially change their driving habits if gasoline climbed above $8.50 a gallon. And this is really an example of demand destruction. And the other big picture for demand destruction is the impact of inflation. The reason why you can't just simply always inflate your way out of any economic problems, and the solution is always to loosen monetary policy, is because usually when you have cost push inflation, whether it's due to supply or if it's due to the supply of money being too high or the supply of commodities being too low, what you get is at a certain point, the prices rise faster than wages to the point where there is material demand destruction. People eventually start to try to cover it with either credit card debt or dipping into savings, but eventually even that breaks and there's just no money anymore to buy the elevated prices of goods and services. You see the most shocking demand destruction type curves in things that are necessities like food, energy, and real estate. I saw a chart with St. Louis Fed data that shows the fastest move nominally in housing price contraction ever, because housing prices combined with high interest rates just created demand destruction. And once it was a crazy red hot market, was just the demand just completely goes away. It's not a gradual decline like, say, tennis balls. It's just the demand just completely just disappears after a certain level. People are just not willing to pay, even if it slightly goes down in price. And that is the same also with grocery stores. We're starting to see the first time in a while that even though you may see grocery bills stay at the same level, the quantity has declined in terms of goods and services bought at the grocery store due to inflation. You're also seeing demand for gasoline fail to recover to the same levels of this time in 2019 and last year, despite having, in theory, a larger population and a larger economy. So the main implication for demand destruction is that you're going to get a tighter, more restrictive economy one way or the other, whether it's through monetary policy, tightening interest rates and increasing the cost of capital and decreasing demand through less borrowing power, or through inflation, just shrinking people's budgets and forcing cuts that way. So it's not really a choice between intentionally slowing down the economy or having a great economy with inflation. It's whether your economy dies through tighter monetary policy and speculative assets falling and debt deflation, or it's whether your economy tightens through demand destruction on the inflation side. You can't escape the economic cycle. You're going to get hit one way or the other. Let me know if you have any questions, and thanks for watching.